This will be available as podcast on all of your favorite platforms under that Lead Lag Live banner. I'm excited for this conversation. I've been tracking Bilal for quite some time. He built a hell of a business with Macro Hive. We'll touch on that. With all that said, my name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Bilal Hafeez. Bilal, for those who are not familiar with who you are and your background, introduce yourself. Who are you? How'd you get interested, involved in markets? Where are you located? And what are you doing with Macro Hive?
Sure. Thanks a lot, Michael. I'm a big fan of your work, by the way, and honored to be on this Twitter Spaces. And thanks a lot, everyone, for joining this Spaces. So in terms of my background, I'm based in London in the UK. I've been in financial markets for about 25 years. Before Macro Hive, I was working for investment banks. I started off at JP Morgan in 1997. Back in the late 1990s, I was on the research side covering emerging markets, foreign exchange and developed markets as well. Then I was at Deutsche Bank from 2002 up until 2015, where I ran various research groups, foreign exchange research. I was in Asia for a while running Asia research. I set up a cross-asset research group in London as well. Then I had a couple of years at Nomura, the Japanese investment bank in London, where I ran research out of London for Nomura. Then in 2019, I left all these big banks and set up Macro Hive, which essentially is an independent research provider. So we provide research for all sort of categories of investors. We have a higher tier product where we provide research for some of the leading hedge funds in the world. And then we also have a product for individual and private investors as well. And we cover all markets from, bonds, FX, equities, all the way to crypto as well. And we've been doing this for about three and a half years now.
Given your experience on the institutional side, building research arms, what makes for a good research team and a good research process? I have to imagine it's more than just sort of the argument of find smart people.
Correct. Yeah. I mean, I think there's a few things that are very important. Number one, it's very important to have some kind of framework, because on the institutional side, people want to see that you've had some thinking around how you come up with your ideas. So having some kind of framework, whether that's a very fundamentally driven framework, whether that's a technical or chart-based framework, people generally like to see that you are, have some kind of framework. The other is to be data-driven. So to try to, validate a lot of your arguments as much as possible with data. And then the other thing is humility. Clients like researchers who are humble in the sense of when you're wrong, for you to put your hand up and say, I was wrong. Clients don't mind it if you're wrong. We're all wrong, as much as we're correct. And then talk about what you've learned from the period of being incorrect. So framework, I think, is very important. Being data-driven is very important. And that sort of humility, I think, is the other thing that's very important.
Yeah, it's interesting. I always found it a bit odd over the last, decade plus that there was such a drive to find, PhDs and people that were actually not in the finance field for investment research type of jobs, right? A lot of the job openings were kind of, I'd argue, tilted towards people not in the industry, maybe quant oriented. I don't think that point about humble and humility is easy to find unless you've actually been investing and in the financial field for a while. Did you yourself ever find that to be maybe counterproductive, the idea that you try to recruit people who are not necessarily from the investment industry or know anything about investments in general?
Yeah, I mean, that's always a tricky one. I mean, there is definitely a place for hiring kind of rocket scientists who are very quantitative. But in the end, what you have to remember with very quantitative approaches is that no matter how fancy the maths is, what they're in essence doing is looking at the recent past or some past period and assuming that past period represents the future as well. And so you basically build these fancy models, which are based on some, past period. Maybe it's past 5 years, 10 years, 20 years. And then you assume the next 5, 10, 20 years is going to be the same. And those models would therefore work. And that works fine when the regime you're in is very stable. And so that's where, quants are very good if you're in a stable regime. Where you do need that experience, having some skin in the game, having been in markets, having that market experience is very helpful when you're going through regime changes. That's where that kind of intangible human quality kicks in, where you can say, hang on, even though the models and all the things we've been looking at for the past 5, 10 years are saying one thing, actually the world's changed. So we have to do something different. So I do think that, especially at turning points like we're in right now, there's a lot of value in actually skewing or listening more to people who have more experience in financial markets themselves rather than people from outside.
Yeah, so actually, I think it's actually kind of an interesting discussion to go with, because the term fancy models to me is one I agree with you on in terms of the sentiment. So studies would suggest that the more variables you have in an equation, the more you try to curve fit and over optimize, the more it fails, because you're trying to find something that has a conclusion where there's a lot of errors that can cross correlate against each other. So more complex models are more fragile, right, than less
Yeah.
complex models. And you can argue that the institution that has the fanciest models is the Fed in terms of how they think about monetary policy. I'm curious if you're of the mindset that being simpler would be the easiest way to deal with, volatility in inflation, meaning go for a Taylor rule, go for something that's just based on a few variables rather than have all these economists, PhDs who don't know about markets and don't have that humility.
Yeah, absolutely. I definitely agree with that. And it's interesting that the Fed, as you say, has all of these PhDs, and they're very good at building elaborate models to explain what's happened in the past. That's what they're very good at. But they, as we've seen over the last few years, they've done terrible using those models to tell you what's going to happen in the future. And if you listen to the rhetoric of the Fed over the past 6 to 12 months, they've been moving further and further away from models, and instead, essentially saying, actually, we don't know what's going to happen in the future. And we're going to just look at very recent data and use that as our best guide. So they actually sort of pivoted away, moved completely away from relying on those models because they've essentially failed them. And you're right. I think the other issue I find with the Fed and their use of models and all these PhDs is it gives them a false sense of confidence, because there's this human bias we have where if something looks very complex and you have people working on it who have all the right credentials, go to all the top universities, that somehow that's more correct than a more simple approach, which seems almost trivial. And that ends up leading to policymakers having that false sense of security, and they double down on policies that are incorrect. And I think the Fed is as our other central banks are learning firsthand the problem in that approach.
I also think there's a degree of sort of what's the right word? Sort of an incentive to make it seem like it's more complex than really it should be, because the more complex any profession or job is, or the more it appears to be complex, the more you're going to have resources attached to it, right? Because only they can figure out. So we got to hire more people, give them more leeway, and give them more power. Whereas simplicity ends up being not only probably more effective, but just more resource efficient. So we're going to be talking about macro and markets here, but I'm just kind of, I myself kind of struggle with how do you turn monetary policy into a more effective, efficient type of tool when you have these embedded incentives by all of these hundreds of very well-paid researchers to not maybe dig deeper to the truth, which is that it's not as complex as it's being made out to be.
Yeah, I think that's right. And at the root, or at the foundation of that, in many ways, is this notion that economists or economics as a subject and as a field does suffer from physics envy, where they look over at the physicists and scientists and see that models there work really well, and they want to be viewed as scientists rather than humanities or more of an arts subject, but than the science subject. So there's always been this issue in economics that has sort of pushed it more towards using complex models to try to make it appear to be more precise, more so-called sort of scientific. The irony, of course, is that the way science works is that science works by coming up with explanations and theories that match the real world and get validated by the real world. And then when those theories and explanations are incorrect, then you throw out those explanations. Whereas if you look at the history of economics as a sort of theory and as a subject and central bank thinking, there almost seems to be this thing where there's this tendency for the field to say, actually, the world is wrong. The models are correct. And so it almost goes the opposite of what science teaches you. But there is this physics envy, I think, that permeates economics as a field in general and amongst central bankers in particular.
Yeah, I just tweeted that out. I love that quote. I think that's spot on. Okay, so let's talk about last year and then this year. I've been ad nauseum hitting on this point that last year, by all kinds of metrics, was an anomaly. It's more than just the idea that treasuries lost more than stocks in a highly volatile period for stocks. It's also the way that stocks lost money in terms of the number of weeks, the way that treasuries lost money in terms of the number of weeks. A lot of things, based on history would suggest that last year was really an outlier. To me, the real question is, are we going to see some degree of normalization? And when I say normalization, I'm not talking about a bull market. What I'm really talking about is correlations going back to their historical averages, kind of reverting after last year's extreme movement. Give us your take on where you think we are in terms of asset class correlations, because I think this is far more important than the question of whether it's a bull market or bear market. It's really a question of, will diversification work again?
That's a great question. And I think you go to the heart of the issue. And, last year, the big debate amongst asset allocators was, would bonds be your safe haven in a world where risk assets were selling off? And obviously that wasn't the case. We saw this incredibly unusual, as you rightly point out, a period where both bonds and equity sold off. And pretty much every asset sold off, aggressively last year. So there was nowhere to escape to. At its heart, obviously, the kind of underlying reason for that was inflation turned out to be higher than expected. The Fed and other central banks raised rates more than expected, and that ended up leading to bonds selling off and also equity selling off as well. Now, if we look at least the first few weeks of this year, it does seem like there is a normalization and correlation occurring, where we're starting to see some of the more usual patterns starting to return in terms of the way bonds and equities are starting to behave with each other. My overall caution, though, and this is a bit of I'm kind of evading trying to answer your question here, is it's very hard to say whether the typical correlations will return this year. And the reason I say that, and my hesitation in being too bold in making a call, is that I do think we have undergone we are in the midst of some kind of regime change in markets. What is that regime change? That regime change is that we've been in this environment of very low interest rates for a long, long, long time. At least since the global financial crisis, where rates have just gone down dramatically. And the Fed has always been able to cut rates whenever there was a problem in the world, especially in equities. Now, last year, that stopped being the case. The Fed was unable to cut rates when there was a problem because of inflation. And I do think that when you go from a regime of very low interest rates for a long, long period of time, and you suddenly transition to an environment where interest rates are higher than before, and you also know that central banks' hands are tied insofar as they can't easily cut rates if there's some volatility in markets, then that tells me we're still in this unstable environment where correlations will still be unusual or different or unstable. And I still think we're in that environment. And I think that will kind of continue into this year as well. And one issue I find, and what makes it very hard to kind of say that we'll revert back to the old regime, is that if we had low interest rates only for 1 or 2 years and moved to high rates, then I would say we would normalize this year. But because we've had low rates of such a long time, and when I speak to investors around the world, so many of them have turned their portfolios around to benefit from low rates, that I think that there's still a lot of money that has been betting on low rates continuing forever. And I think they haven't made those big adjustments yet. And so I think that this regime change hasn't affected all players in the market. Now, fast money has adjusted very quickly, hedge fund and some individual investors and family offices perhaps, but there's large asset allocators that haven't fully adjusted to this new regime of higher rate. So what I'm saying is I think that we're still in this environment of unstable, correlations, and underlying that is the fact that we are transitioning from low rates to a higher rates environment.
Yeah, I shared in the Nest a tweet that my friend David Durking put out there, which shows that what happened actually this past week was pretty remarkable, even just in terms of the 10 and 3 month yield spread. It seems like there is an increasing disconnect between the message of the yield curve and the message of beta. Yes, stocks had a bad year last year. I put it out, I think the 7th worst real return year for the S&P in history. Yeah. But that still doesn't seem to be enough given where starting valuations are for this year relative to what the yield curve I think is telling us. There's that old saying, right, Bilal, that the bond market is smarter than the stock market. That doesn't mean that it always gets the A on the exam, but you want to pay attention. You can get a sense that the bond market is screaming that we're in a much deeper risk situation than stock investors think?
Absolutely. And for me, there's two angles here in terms of what the rates market is telling you. We've had this deep curve inversion that's been going on for the past 6 to 12 months. And that is telling you that we're in a recessionary environment, that, we either are in a recession now or we will soon be in a recession. So in a recessionary environment, what you should expect is a very weak equity environment. Now, the equity weakness we saw last year was more derating. Earnings expectations didn't move down massively. If anything, they were slightly up. And for this year, earnings are expected to be positive as well, which is at odds with a recessionary prediction from the yield curve. So number one, the yield curve is basically telling you is there is a problem with growth. We are going to be in a recession, and that tells you that from an equity perspective, equity should sell off further than they already have. That's one message from the rates market. The other one I think is perhaps neglected is that there is still this bid for treasuries. For all the talk of inflation and so on, when you look at flows behind bonds, international investors continue to want to buy treasuries. There's been record purchases by foreigners of US treasuries. On top of that, if you look at the reverse repo facility at the Fed, that still is fairly elevated at over $2 trillion, which means that financial players are trying to get hold of treasuries through the Fed's reverse repo facility, even though the Fed is engaging in quantitative tightening, even though the Fed in effect is supplying more treasuries into the market. So that tells you at the micro level in the market, there's this pervasive kind of fear in the market, which is leading to various players in the market just wanting to hold treasuries because treasuries are the sort of most pristine form of collateral that one can hold. And that tells you that there's something quite worrying or there's some fragility in the market. And again, equities don't seem to be paying much attention to that dynamic. So I think there's two dynamics to the yield curve. One is based on yields themselves, is telling you recession, bad for equities. And then the underlying flows behind that yield curve dynamic is telling you that there's this move to safe haven and more pristine collateral, which again is telling you that all is not well, which again should be negative for equities too.
Which counters the narrative that's out there that quantitative tightening means bonds will keep selling off because
Correct.
the Fed is unleashing supply. And it's funny because it's like, I find on FinTwit, people say things without just looking at very basic data. Every time the Fed has tried to sell treasuries, the fact is yields fell.
Yeah. I mean, it's one of those things where markets are very forward-looking, so the market immediately knows that, okay, quantitative tightening means tightening of policy, which means a slowdown, which means slower nominal growth, which means lower yield. And so the market goes immediately to the natural conclusion, whereas some people on FinTwit just look at the first round effect, which is, okay, somebody is selling bonds, which means yield should go up. But the market is smarter than that. It sort of says, actually, that's the first move, but then the second, third, fourth, fifth effect is to slow down and lower yields. And that's where the market ultimately does go to.
I'm curious. So, I mean, I think you can argue that part of that foreign demand is because there's the dollar shortage. Maybe there's concerns about a sovereign debt crisis, which we should touch on too. But one of my themes for this year, well, I have two main themes myself as I kind of think through market dynamics. One is that if last year was the year for duration risk, this year probably becomes the year for credit risk, right? That you're going to see spreads blow out, which we'll talk about in the context of recession. But there's another dynamic I want to get your thoughts on in the context of that treasury demand from foreign buyers, which is that if you look at emerging markets on a relative basis against the US, they're actually slightly outperforming since the start of 2022, which is really strange because you would think, given the strong dollar, given all the headlines around China, given everything that we've seen as far as financial stress overseas, that the stocks of emerging markets, which fundamentally have been cheaper for a long time relative to U.S. equities, that they would have done a lot worse. I wonder, Bilal, if we may be in the midst of some kind of real secular shift in momentum leadership that no longer favors U.S. large cap and might favor everything else outside of it, in particular emerging markets. And I say that because really, for the last decade, emerging markets have been nothing but volatile cash. The U.S. really pulled away from international equities. And a large part of that was because of buybacks, zero interest rate policy, and QE. all of which are done now. Yes, there are still risks, obviously, but I am curious, kind of more of a longer term perspective, if you think there's a case to finally be made for real international diversification versus U.S. only momentum.
Yeah, no, I think that's a great point. I mean, I would make a few observations about the EM stability that we've had over the past year relative to the US. Number one, which I think is a big one, is that the US S&P at least, and broad indices are very skewed towards tech, and that's been one of the reasons why the S&P has outperformed the rest of the world for the last 10, 15 years. And tech, as we know, has benefited a lot from low interest rates. So there's this sort of sectoral bias that the US has that has really helped it in the past and has allowed it to outperform EM, but even Europe as well, a developed market. And that's because of the sectoral sort of weighting that it has towards tech. And tech has been hammered over the past 12 months. It's really tech that suffers the most when we have higher interest rates. So I think one is there's a sectoral skew which has worked against the US over the past 12 months, which I think will probably continue to work against the US going forward, which tells you that there is an advantage now to invest in the rest of the world rather than the US. The other one I think is from a policy perspective, EM in general, did act fairly quickly in response to inflation since COVID. Many emerging market central banks raised rates before the Fed did. And so from a policy perspective, EM actually has done okay. It hasn't, fallen for the same sort of problems it's had in the past where it's late and it allows inflation to pick up before it acts. So there's been some sort of credibility on the EM side. And then in terms of specifics, I think there is some interesting idiosyncratic stories within EM. One has been how well India has performed over the last 12 months. Indian stocks have done incredibly well. And there's a few reasons for that. One has been that there's been lots of international flows that have moved away from China towards India because of heightened geopolitical risk between the two sort of countries. But also from a policy perspective, India's kind of navigated a lot of sort of challenges relatively well. They reopened fairly early as well compared to other countries as well. Growth rates have been fairly high as well. And then the other side is China, obviously. We've had the zero COVID strategy, which has affected things. But now that they've lifted that changes the story for China. So overall, I think from a secular perspective, I think there is a case for favoring international stocks over the US, especially if we are in this more persistent environment of higher rates, then that will de-emphasize tech, which hurts the US. And then I also think that there's certain secular themes amongst certain regions of the world, especially places like India, maybe even Latin America to some extent as well, subject to some of the politics there that do favor them as well in terms of population growth, demographics, and just catch up that they could have in growth sort of pictures. China, I'm less convinced on in terms of being a secular buy, mainly because I think that just the Chinese system is such that there's too much policy risk. That at any point, certain successful sectors could be nationalized or could be heavily curtailed by the state. And so I think that risk premium is there and that will always hold Chinese stocks back.
Your signal can be right being risk on, but your opportunity set doesn't allow for momentum because the secular tailwind isn't there. And that's, kind of been an issue, right? Just in terms of outperforming on the long side. It's very hard for asset allocators to beat the S&P when the S&P is the only game in town, right? It's like I always go back to the idea that if you want to beat the average, you have to choose the right average. It's not so much about the individual stocks. It's about where else are you allocating either globally or on a market cap scale. So presumably, if you're going to have that secular shift to international, the comps against the S&Ps will be a lot easier for those that are trying to actually outperform it.
Yeah, absolutely. Yeah. I think that's finally where we could be at that point now.
Let's go to some of the audience. And everybody, please make sure you follow Bilal Hafeez and check out Macro Hive.
Great. No, good question. Yeah, in terms of sentiment, I would say that, well, one funny thing is coming into this year, my general sense amongst investors was that before the year started, many people had this view that stocks would be weak in the first half of this year, and then stocks would go up in the second half of the year when the Fed starts to ease policy. But now that we've had the first week of trading, that view has been pulled forward so that people are turning bullish on stocks right now because obviously we had the data yesterday, but more generally, it seems like the market wants to play a Fed easing sooner and they want to be bullish on stocks sooner as well. So I would generally say that the sentiment has started off much more positive than I would have thought, as you kind of rightly sort of say. I think some of that has been also linked to the performance, just price action. European stocks have done really well at the start of the year, so Asian stocks, and then yesterday US stocks have done well. In terms of my view around this all, I'd make two observations. Number one, the price action in the first week or two of any year doesn't tell you much, because so much of what happens in the first week or two of the year are just random allocations by funds, which are just more based on decisions that were decided like weeks earlier and less reflective of fundamentals. It's almost like the middle of January onwards, like the third, fourth week of January onwards, is where price action tells you something more real. So that's one. I'd be cautious in extrapolating, moves at the start of the year. The second thing is, if I did have a bias, it would be to, two negative years for equities. And the reason for that is, one, as you said, rates are still high. The Fed's tightening, central banks are tightening. I think that the market is constantly trying to price easings, and central banks continue to keep rates high and high for longer. And then also inflation still is very high. It's still at the highest level since the early 80s. And when you're in that type of environment, and we've been used to low rates for so long, I think it's going to be harder for stocks to, maintain a positive bias for the year as a whole. On top of that, I think there's probably too much optimism around earnings. Now, I know a lot of people are looking for this earnings dip, but it will materialize at some point over the course of the year. And so I think that will also weigh on stocks as well. So I'm kind of cautious in extrapolating the past week's price action going forward.
FinTwit is crazy.
Yeah,
no question about it. It's I don't know, things that get liked and retweeted. If you actually do any kind of back test or any data work, you find that it's largely nonsense. There's something that I wrestle with as a way of thinking about sort of tail risks in terms of the downside for inflation that could actually send stocks, quite a bit lower. Okay, so one would be, let's say Russia were to stop its war with Ukraine, or at least have some kind of prolonged pause. I would think the market's expectation there would be commodity prices would collapse, right? Because then there would be this feeling that Russia is going to suddenly unload a whole bunch of natural gas and oil and fertilizer. That's going to be a disinflationary force if that happens, against a starting point at that point of yields and rates already very elevated. So you're talking about severe relative financial tightening because of this disinflationary pressure of the stoppage of the war, the commodity flow from that, and then already elevated rates. The other part of this is the scenario that China reopening is going to be massively inflationary. I don't necessarily believe that myself, because consumerism is not anywhere near as strong as it is in the West. And it's the same issue. If the shutdown from China is what caused supply chain disruptions, now you fully reopen, presumably there's going to be a whole bunch of new supply of goods. I understand services would stay elevated, but what's your take on the possibility that you could see almost like an inflation crash, for lack of a better way of saying it, which could really throw the Fed off?
Yeah, I mean, certainly if you look at survey, we had some data releases over the past week, ISM, and then we had non-manufacturing ISM. The prices paid component of those surveys showed a really big drop in inflation. And then also, if you look at year-on-year changes in oil prices and food prices, they are rolling over. And if, as you say, if the Russia-Ukraine situation eases, then you'll see a sort of a larger sort of drop there. So I certainly think that there is that possibility of us seeing a big drop in inflation. And certainly when you have supply shocks, historically, if you look over the 1970s, when you had the big commodity shocks and supply shocks, you had these periods where you had very high inflation, then it collapses very quickly. So I think that's definitely on the cards. In terms of whether I'm in that camp, I'm probably not in that camp at the moment, at least, because I think that one of the issues we've had over the past year or two is that we've had this kind of rebalancing shock to economies, especially in the West, but also in the EM to some extent as well, where the COVID like goods sector basically got smashed. Well, the service sector got smashed during COVID, and then the goods sector got sort of massively boosted, which then caused a lot of inflation in the goods side, but not on the services side. Then as we've reopened, it's reversed the other way around, where there's been overproduction of goods, and now services is having to come back. And if you look at, say, the labor market data, that came out yesterday, what we continue to see is that essentially there's still less people employed in restaurants, less people employed in the health sector, less plumbers than there were before COVID. So we're still in this kind of imbalanced situation where there's certain segments of the service economy that aren't back to where they were even before COVID, where there's other parts of the economy where you have too many workers. There's too many workers in tech. There's more people working in tech than there was before COVID. There's more people working in warehouses and kind of the good side than there was before COVID. There's more people working in finance and lawyers than there was before COVID. So those are the segments that are shedding labor. And so because of this imbalance in the economy, that kind of tells me that I think there's this sort of almost like a structural story, and you hear different people talk about this in different ways. There's early retirement stories. There's, when you go to restaurants, they're packed, and anecdotally, you speak to people in the service sector and they all talk about how it's really hard to find workers. And what's exacerbated all of that, which is probably less discussed, is what COVID did was it stopped immigration as well in all countries, and immigration numbers haven't picked up to where they were before COVID. And immigration is kind of like the balancing labor supply number, which kind of, it just balances the economy. And I think that's another form of sort of shortage. So because of that, I do think that we have this aspect of inflation that's going to be more sort of persistent, that is almost kind of independent of what's happening in China and commodities and so on, which is to do with the shock that COVID has done on the economy and the lockdowns that are associated with COVID, that kind of imbalance the economy in a strange way. And we haven't completely undone all of that yet. Yeah, no, great questions. Yeah, in terms of who to read, I think you're right. Howard Marks is a great one to read. I also find it helpful just to read contemporary writers, but also to read things from the early 80s or the late 1970s. So, one can read, for example, speeches by the Fed, Volcker, around that time, or read books from that period. And what I find interesting is that there's lots of parallels. When you read the accounts from that period, there's lots of parallels to today. And I think that that's helpful in trying to contextualize where we are today. I think in terms of other writers that are good, I think Warren Buffett, although he doesn't often talk explicitly about macro, I always find what he says quite helpful in terms of, because he tends not to get caught up in fads and tends to focus on fundamentals, and looking at what he says, and then on top of that, what investments he's making, I think is very, very helpful as well. And let me think of who else. I mean, we at MacRi, we're producing lots of interesting work. So I'd also sort of, I'd probably mention that as well. One thing that we've written about is how, in terms of not fighting the last war, what's interesting over the last 10, 15 years there's been a massive growth in shadow finance, in the shadow banking system. So if you think about this, the global financial crisis was driven essentially by a housing bubble associated with bank balance that grew too large with all these mortgages, which then blew up around the global financial crisis. Now, what's happened since the global financial crisis, banks are so heavily regulated that all the new money creation has occurred outside of banks through non-bank entities, whether that's insurance companies offering different forms of credit, the private credit markets, private equity, and so on. That's grown and has become larger than the bank credit system for the first time in history. And so I think the shadow system, I think, is the one to look at, and especially private markets as well. So I think any sort of discussion around private markets, I think, is also worth looking at. So looking at commentators who talk about private markets, I think is worth doing. Now, in terms of the investment sort of views, as you rightly pointed out, last 10, 15 years, there's been this bias towards, big tech to simplify things, and then China. I think going forward, I think that what makes more sense is to focus on the areas which are kind of more basic, you could say. So one, I think, is natural resources. So commodities, I think, is at the sort of central problem for the global economy going forward. That do we have enough energy, fossil fuels, there's an energy deficit, you could say. And I think that sector is going to be particularly, it's performed well last year. I think that will become a sector that will continue to perform, going forward. And you often find this, especially after you have phases of strong tech outperformance, that there's an aversion to more basic industries, such as energy. You saw that in the 1990s and 2000s. The 1990s, tech did really well. Then 2000s, it was commodity sectors that did really well. And so we're almost kind of going back to basics around the sectors which are more fundamental to us all living, energy and food and such. I think that will continue to be a sector that will perform well. And then in terms of regions, rather than China, I do think countries like India, maybe Latin America, I think could be really interesting going forward. Now, already there has been some flows that are moving into India and LATAM, but I think that will continue as well as a secular shift going forward. So that's a fantastic point. It's interesting. There's actually a lot of academic work that's gone into this area where you do in general find that countries that sort of defend property rights, are more supportive of private sector, more democratic, those markets do tend to perform better over time. And a big part of that is around how, as an investor, you need to have some assurances that the income of the country, you can get access to that on a sustainable basis. The problem with illiberal countries or, dictatorships and so on is that they capture the returns and they can just nationalize things in a way that doesn't occur otherwise. So I do think it does make a lot of sense to skew towards countries that score higher on economic and political freedom than before. And I think that you're correct. That's actually probably a better benchmark to use than current benchmarks, which are market cap weighted, which are just you invest based on the biggest markets in the world. I think that's not such a good benchmark to use. Now, of course, the challenge is even, liberal, and I'm using the word liberal in the sort of general political sense, not in the US sense of left wing, liberal as in respecting property rights and so on. There's even democracies are starting to become more autocratic as well. So even the countries that you think are the sort of economically free countries, it's not clear whether they'll always remain so. So one needs to be careful in making adjustments as well going forward. But I do think it does make sense to skew towards countries that score higher on measures like the economic freedom indices and so on.
I also think it's also about time frame, right? So, the more time that goes on in an investment, the more likely that that tail event, as far as the property rights, kind of comes into play. Yeah. But in the short term, I'd argue that there's some real, if you're a real trader, you could probably get some massive performance in China stocks, because among the advisor community, I know for a fact, a lot of advisors have refused to have any kind of China funds or China allocations among their separately managed account portfolios because there's statement risk. They don't want their underlying clients to say, why the hell are you investing in China? Even though it could be the cheapest part of the EM space, even though we can debate whether it's an emerging market or not. So, yeah, for allocators, I agree with the idea of having an allocation towards the kind of more freedom type of EM plays. But for real traders, yeah, you can get some interesting, upward momentum, I would think, in Chinese stocks.
Yeah, Michael, and just to add to that China point, what's been interesting is the announcements from China over the past few weeks, where they're essentially stepping back from a lot of their restrictions they put on the private sector 1 or 2 years ago. The 3 red lines around property, they're easing some of the restrictions on the tech side. So it seems like they've recognized they made a mistake there and they're reversing that. And so I do think I agree with you on that side that you could get these kind of tactical bounces which not everybody can participate in, which if you're an unconstrained investor, you can really take advantage of.
Let's go to for a question.
Yeah, sure. So, you're talking about Canada specifically, I think from your question. So I would say there's a few things. One is that Canada actually has been, as you rightly pointed, in terms of immigration, it's been one of the outliers in terms of it's really sort of picked up the pace on immigration and taken advantage of the fact that other countries aren't allowing immigrants into the country. And you do have this issue in Canada, as well as other countries as well, where there's this kind of inbuilt bias within policymakers not to ease planning to allow, housing supply to pick up in the right places more easily. So you do end up in this concentration risk in certain cities where prices do sort of pick up quite sharply. The punchline, I think, ultimately is that in the case of a place like Canada, if we don't get that housing slowdown as much as it should be, and we are seeing this in other countries already, as the housing slowdown, including the US, then the Bank of Canada will have to hike rates even more to induce some kind of slowdown if there is no governmental response. I mean, what the government should do is that it should have some kind of regional policy. It should have some kind of planning policy to ease housing supply issues. In the absence of that, it will fall on the central bank to have to raise rates. Now, one interesting sort of difference today versus, say, 2008, when we had the global housing crisis, is that banks have actually been a bit more cautious in how they've been lending money for mortgages and housing. So the quality of borrowers today is better than it was before, which means that there's kind of more of a buffer that people have in terms of their incomes before they really start to sort of default on mortgages. Also, it depends on when the mortgage is reset as well. So it takes a bit of time for higher rates to sort of feed through. But overall, I think that this ultimately means that the central bank will end up having to raise rates more than people thought beforehand.
So we had talked about earlier sort of tail events around a disinflation or deflation shock, whatever you want to call it, whether it's credit risk or China, Russia, or whatever it would be. I'm curious if you've been tracking any of this stuff going around with the FTC's proposal around removing these non-competes. And I say that because that to me is actually really fascinating. If I think through sort of the way that could play out, if somehow the FTC were to pull it off and now non-competes among employees and employers are no longer effective, that sounds like a wage inflation shock, because companies then are going to compete for talent immediately after they either leave their existing employer or whatever it would be. Any thoughts on that, Bilal? Because I think this is one of those like butterflies that if it does end up flapping its wings, could have massive ramifications.
Yeah, that's a great point. Yeah, if that does come through, I agree. It would be inflationary on the wage side. One reason for that is if you look at wage growth at the moment in the US, what you find is that the highest wage growth is occurring with so-called job switchers, people who switch jobs. So people who remain in their jobs, their wage growth is much lower than people who jump jobs. That's how you get a big sort of increase in your wages. So if you did see the end of these non-compete clauses, then suddenly you'll see more job switchers, and that will just push up all of the wage growth numbers. I think the one caveat I would say is, from my understanding, correct me if I'm wrong, Michael, but I think a lot of these non-competes really is more focused on in sort of the tech sector more than any other sector, and maybe in finance as well. And those sectors are already kind of vulnerable and they're shedding jobs. So that's my one kind of area, kind of concern there. So I think it could be interesting, but my only kind of thing around this would be just is it skewed towards certain sectors which are currently weak or not? And maybe I'm wrong. Maybe it's not skewed towards those sectors, but
it's a good point. I mean, I don't know myself, but I'm seeing this on the periphery myself that that could have a lot of interesting implications on policy. Okay, so maybe as we get to the top of the hour here again, everybody, please make sure you follow Bilal and check out Macro Hive. What are some of the more interesting pieces that you think you guys have put out that maybe isn't getting as much mainstream attention from a macro perspective? Anything particularly interesting when it comes to the Forex side? I mean, the dollar was all the rage last year. I mean, I actually don't think the dollar's move is over, and because credit risk, I think, is still out there from a sovereign perspective. But any thoughts there? And then, maybe just kind of touch on gold, because gold has had some interesting momentum as of late. My opinion on this is that gold is moving because allocators believe the bear market's going to take time.
Yeah, sure. Well, we put out a piece towards the end of last year, which was our Grey Swans for 2023, which is kind of black swan events, which could happen in 2023. We call them grey because as soon as we write about it, it's no longer a black swan event if it was to occur. So we list
and Talib will chop your head off, by the way. He did this to me when I
oh, did he? Okay.
Yeah, anyway, more of a side note.
Yeah. So that was kind of, I think it's definitely worth looking at, where we kind of list a bunch of things that could be interesting for this year, from very positive scenarios where suddenly you get things like what we talked about earlier, Michael, like peace around the world, a rapprochement between US and China, and then you end up with a much more positive, outlook going forward. All the way to more negative sort of scenarios as well, where we see sort of financial market crises and so on. So that's worth looking at. I'd sort of just flag that. The other one is we recently put out a note on private equity markets and private markets, where we talk about how private markets are going through a Wile E. Coyote Roadrunner moment right now, where their returns are still inflated. Last year, private equity apparently still delivered almost positive returns for last year, even though stocks were down 20%. And, from my perspective or our work, a lot of it is because private equity funds mark their valuations themselves. But if you look under the hood, it looks really ugly what's going on in private equity right now. One ugly part of private equity is that last year, there were almost no major private equity exits into the public market. So private equities were only able to sell their holdings to other private equity firms last year. They weren't able to sell into the public market, which I think is quite telling. So I think that's one to watch. There's a huge, amount of money in private equity. Pension funds are massively invested in private equity as well. And when pension funds underperform, that becomes political, because pensioners don't like to have their pension funds under fire. So those are two I'd probably flag. On the dollar, I do agree. I think on the dollar side, I still think we're in an environment where the dollar could strengthen against a number of currencies over the course of this year. So I think that the turn in the dollar we saw in September may be a temporary bout of dollar weakness, partly because, as you say, Michael, that we do have the chances of credit risk, recessions, and this kind of negative scenarios. On gold, then, I think that gold, recently has done relatively well. And that's partly because the dollar's been on the weak side and bond yields have been falling as well. Going forward, I'm not sure if that will necessarily continue. If we do get another bout of dollar strength, if bond yields pick up a bit again, then gold, I think, will start to come under fire again. So I think at the moment, the short-term dynamics look positive for gold, but structurally, I'm not convinced on gold at the moment.
Yeah, no, fair enough. And again, everybody, please make sure you follow Bilal. This will be a podcast under that Lead Lag Live banner. Bilal, you and I will be in touch, but great conversation. Thank you, everybody, for joining.